Manual intervention on quoting. Occasionally markets are very illiquid. So a client is trying to trade in too big size that the spread betting company will permit in that market or for that particular period of time. Perhaps it's very volatile and the client suddenly wants to trade £1,000 a point in some illiquid stock. And that comes through to the dealers, and the dealers say, look, there just isn't £1,000 of stock equivalent. So £1,000 bet is 100 times that, so that's 100,000 stock. And they're looking at the London Stock Exchange and Chi-X, and there's 20,000 on the offer. And they're going, look, there's only 20,000 on the offer. The next offer is another 4p higher. I can't give you 100,000 shares there because I'd immediately be in a loss-making position. So sometimes when market conditions are illiquid or very volatile, then there might be some manual intervention, but it's very rare nowadays, to be honest, very rare.
Spread betting providers take the other side of trades. Is there a conflict of interest?
It's conflict of interest in spread betting is very difficult to get away from. Obviously, if the client wins, he wins off the spread betting company. If he loses to the spread betting company. So you couldn't really think of a much bigger conflict of interest. It's in my interest for the clients to lose money if I'm the spread betting company. But it's the same in every type that you're trading, any instrument you're trading. The person that you traded with, okay, you might not know who he is. The difference between spread betting and normal trading is that you know who the other side is. But in normal trading, I don't know who it was I sold or bought from. They're just somebody else in the market. Now, the conflict of interest comes from the point that if I know what your position is and it's in my interest for you to lose, I could theoretically bias the price or manipulate the price to ensure that, not to ensure that you lose, but to make it easier for you to lose, i.e. bias the prices. In reality, it just doesn't happen because the vast majority of the time, whilst you might be buying, 3 seconds later I've got somebody selling the same product or selling, you've just bought the Dow, somebody else will sell the S&P. Somebody else will sell the FTSE or the DAX. And in effect, the spread betting companies, they all look at all their indices markets as one big book. And because they recognize that a very large move, if the Dow moves very large upwards, it's I think it's probably never happened for Europe to move very large down when America's moved up. So you look at it all this, and all the trades coming in generally go against each other. So every time one client wins, another one's lost somewhere. So it's difficult. But in the end of the day, there is a conflict of interest. But the spread betting companies, to be honest, don't do anything about it. They just sit there and take all the trades and let the clients get on with it.